I struggle to find words to express just how fundamental good quality financial and non-financial information is to an investor. It is our lifeblood. It allows us to assess the performance of a company and to compare how well it is doing relative to others in its sector. Without it, we are out of a job. So what can you do to ensure that the data presented really meets the needs of shareholders and investors? First, put yourself in our shoes. Ask yourself what question investors are trying to answer. Can they get a clean line of sight on trends in margins and cash flow? Can they reasonably calculate the company's return on capital employed, sometimes called ROCE, or its return on invested capital, ROIC? Critically important, do they have enough segmental information to build a model with a degree of confidence? Second, don't forget the need for good quality contextual information. The stuff you typically find in 10-Ks and annual reports. Things I find useful include information about market conditions, its size, the rate of growth, the company's share of market, and so on. I also want to understand where management thinks the biggest opportunities and threats lie, and to know how they are going to tackle both so that I feel confident that they are in control. People often ask me about non-financial data or alternative performance metrics. Yes, it is part of the everyday toolkit of an active investor, but its usefulness varies. Let's take adjusted financial numbers. Sometimes the adjustments made by management make sense. They strip out something that is clearly non-recurring, for example. Sometimes, though, they strike me as a little arbitrary and even suspect, an attempt to sweep something unsavory under the carpet. So if you are presenting adjusted financials, make sure you explain why you're making those adjustments and present a really clear reconciliation back to GAAP. In a similar vein, I really value a number of the KPIs presented by management: same-store sales, revenue per user or employee, etc. But here, I really need management to play fair. As there are no rules governing how most of these KPIs are prepared, I need to know how management is defining a same store, for example, so that I can try to compare across a peer group. Even better, if there are implicit standards emerging on how to calculate these things, then stick to that industry practice. That brings me to the credibility of the information presented. Let me start with the elephant in the room. Yes, the audit is valued. Without independent assurance of the financial information presented, the market would descend into some ugly version of the Wild West. But that begs the question, and one that I will pose to you. Can anyone tell me why assurance stops at the back end of the report? Many of the numbers that move markets and that underpin executive comp lie outside the formal financial statements. How about assuring some of those?